Nokia's stock is currently sitting at $4.22 per share, up roughly 1.4% during today's trading session as volume builds across major exchanges. Most people glance at that single-digit share price and immediately assume Nokia is just a ghost of the cell phone era, a forgotten tech giant trying to stay relevant in a market that moved on long ago. But if you look past the ticker symbol, the reality unfolding behind the scenes is completely different from what retail traders expect. While the public thinks Nokia is struggling to keep up with massive telecom shifts, institutional buyers and smart funds are quietly placing structural bets on something far more profitable: the private industrial network boom and optical transport infrastructure. This gap between retail perception and institutional reality is where the actual trade lives, and understanding why the market is mispricing this business requires looking directly at how money is moving through the space today. When you open up Robinhood stock trading or check your Interactive Brokers account, you see Nokia floating in that low dollar range, making it look like a sluggish penny-style value trap. Retail investors using SoFi Invest or self-investing through a Fidelity brokerage account often ignore it in favor of high-flying semiconductor plays or massive mega-cap tech titles. The general belief is that telecom equipment suppliers are trapped in a low-growth cycle because big telecom operators like AT&T and Verizon have already pulled back on their initial fifth-generation wireless capital expenditures. That belief isn't entirely wrong on the surface. Carriers did front-load billions of dollars in network equipment over the past few years, leading to a temporary spending digest phase that hit revenue across the entire hardware sector. But treating Nokia strictly as a carrier-dependent vendor misses the massive shift in their revenue mix. If you look at recent trading sessions, Nokia stock has shown a surprising amount of resilience, absorbing broad market sell-offs and holding key technical support levels around the $4 mark. Institutional volume has been steady, with block trades showing up whenever the price dips toward multi-month lows. What these large funds understand, and what most everyday investors using an individual brokerage account miss, is that Nokia's revenue engine is actively decoupling from traditional wireless service providers. The company is aggressively capturing market share in enterprise network builds, data center interconnects, and high-speed optical routing. Cloud providers and large-scale enterprise clients are spending heavily to build out their internal digital backbones, and Nokia is providing the physical hardware and specialized chips that make those networks function. Consider what happens when you track the actual order books through an Interactive Brokers platform or look at sector ETF flows on Fidelity Investments. You begin to see that equipment demand isn't dead. It is simply migrated from public cellular networks to private corporate environments. Automated factories, deep-sea shipping ports, defense facilities, and massive cloud data centers all require ultra-secure, low-latency private networks. Nokia has emerged as an absolute dominant force in this specific niche, securing hundreds of enterprise customers who want their own dedicated infrastructure. While the market continues to price the company based on old carrier spending patterns, the higher-margin enterprise business is steadily expanding underneath the surface. Let's pause right here for a quick sanity check on how retail investors are positioning themselves in this name. Comment below how many shares of Nokia stock you currently hold in your portfolio, or if you've strictly been watching it from the sidelines on your trading app. To really understand why this expectation versus reality dynamic exists, it helps to step back and examine how Nokia actually operates today. The modern Nokia is structured around four primary business segments: network infrastructure, mobile networks, cloud and network services, and Nokia Technologies, which manages their massive intellectual property portfolio. The network infrastructure division handles subsea cables, fiber optic routing, and fixed network solutions. This is the segment currently benefiting from government broadband expansion programs across North America and Europe, as well as the relentless demand for high-bandwidth data center routing. Mobile network segment is what most people think of, the massive cellular base stations and radio access network equipment sold to telecom operators. Cloud and network services provides the software layers that let corporations manage these complex systems, while Nokia Technologies generates high-margin cash flow by licensing thousands of essential patents to smartphone manufacturers, automotive brands, and consumer electronics manufacturers. Looking back at past earnings reports and long-term financial performance, Nokia spent years cleaning up its balance sheet and fixing internal operational inefficiencies after spinning off its legacy mobile phone division decades ago. Management focused on debt reduction, cost containment, and research investment, ensuring that the business could survive cyclical downturns in telecom spending without needing outside capital injections. That disciplined capital allocation is why Nokia maintains a healthy cash buffer today, allowing them to fund ongoing dividend payouts and systematic share buyback programs even during periods when hardware demand slows. Right now, market dynamics are being driven by a combination of macroeconomic pressure, interest rate expectations, and shifting geopolitical priorities. Governments in North America and Europe are actively pushing to secure critical telecommunications infrastructure, favoring trusted Western equipment vendors over foreign competitors. This regulatory tailwind gives Nokia a durable long-term advantage in securing public infrastructure contracts, particularly as nations roll out multi-billion-dollar initiatives to bridge digital infrastructure gaps in rural areas. When these government-funded projects transition from planning phases to actual equipment orders, hardware suppliers with established distribution channels stand to capture significant order volume. For traders using online investing platforms like Robinhood app, SoFi Active Investing, or a Schwab Intelligent Portfolios account, the challenge with Nokia stock has always been patience. The stock rarely moves with the violent upward momentum seen in speculative software or high-beta hardware plays. Instead, it trades in defined ranges, heavily influenced by quarterly earnings surprises, macro tech sentiment, and broader sector rotation. But for investors focused on value metrics, the current valuation presents an intriguing puzzle. The market continues to price Nokia as if its earnings will permanently remain tied to sluggish telecom capital budgets, ignoring the steady growth of its optical transport and private enterprise segments. When you run a deep fundamental analysis, the core question comes down to margin expansion. Traditional mobile network hardware carries lower profit margins because giant telecom carriers possess immense buying power and negotiate aggressive contract pricing. In contrast, enterprise customers and specialized data center operators buy customized high-performance network equipment that carries significantly higher gross margins. As the percentage of total sales generated from enterprise clients increases, Nokia's overall profit profile improves, even if total top-line revenue growth appears modest on paper. This structural margin expansion is precisely the outcome that traditional Wall Street models often underappreciate until it shows up directly in bottom-line quarterly earnings prints. Looking ahead toward future catalysts and potential risks, several key factors will dictate where Nokia stock trades over the next 12 to 18 months. On the bullish side, an acceleration in enterprise network adoption, combined with the deployment of government broadband stimulus funds, could trigger a sharp upward revision in consensus earnings estimates. Additionally, as artificial intelligence workloads expand across global data centers, the demand for specialized optical interconnects that move massive amounts of data between server clusters without bottlenecking is accelerating. And Nokia's optical networking division is directly positioned to capitalize on this hardware requirement. On the risk side of the equation, macroeconomic weakness could lead to corporate IT departments to temporarily delay major network overhauls, extending the sales cycle for high-end enterprise equipment. Furthermore, if traditional telecom carriers extend their capital spending freeze longer than anticipated, the cash flow generated by Nokia's mobile networks unit could remain depressed, placing a temporary drag on overall corporate margins. Competitor pricing pressure from rival Western equipment makers remains an ongoing factor that management must continuously navigate through innovation and cost discipline. When you balance expectation against reality, the takeaway becomes clear. The market's current expectation is that Nokia is a stagnant legacy hardware maker trapped in a low-growth industry with limited upside potential. The reality is that Nokia has quietly transformed itself into a critical provider of high-margin enterprise infrastructure, optical data center routing, and protected intellectual property. While retail traders ignore the stock because it lacks fast-paced headline momentum, institutional capital continues to recognize the underlying value, balance sheet stability, and structural tailwinds quietly building beneath the surface. Navigating a position in Nokia stock requires looking beyond short-term market noise and focusing on the slow, deliberate transition occurring within its core business model. Disclaimer: this video is made only for educational and informational